Did you know that over 90% of amateur traders lose money simply because they treat the market like a giant lottery ticket? Welcome, everyone. If you're tuning into this explainer, you're likely looking to decode the financial markets, cut through the noise, and really understand how the pros operate. Well, you're definitely in the right place. We're going to break down the absolute essentials of market navigation, distilling exactly what separates the massive successes from those who just participate. Okay, let's dive into this and uncover the mechanics of essential trading foundations and strategies. Right out of the gate, we've got to shatter a massive illusion. So many beginners jump into the market just hoping for quick money, basically treating the stock exchange like a casino. They rely purely on luck, zero strategy, no plan. Listen, that is the literal definition of gambling. Real trading, on the other hand, it's a completely different beast. It's built on a solid strategy, deep knowledge, strict discipline, and unbreakable rules. A trading strategy is basically your playbook. It tells you exactly when to get in and when to get out. Without it, you're just throwing darts in the dark and letting emotional chaos take the wheel. So to replace that emotion with concrete rules, we've broken down our toolkit into 4 thematic buckets. First, the foundations. Second, the triggers. Third, the shield. And finally, your path to trading success. We've taken 10 complex strategies and neatly organized them right here.
Section 1. The Foundations. Reading the Market.
You've probably heard this famous quote before: "The trend is your friend." I know it sounds super cliche, but it's the absolute bedrock of trend following. Honestly, this is arguably the simplest and most effective strategy out there. The whole idea is incredibly straightforward. You just trade in the exact direction the market is already moving. So if the market's in an uptrend, you're actively hunting for buying opportunities. Downtrend, you look to sell. Now, traders use tools like moving averages to spot these trends, but keep in mind no trend lasts forever. Even when you're riding with your friend, you always need stop-loss orders in place to protect your capital from those nasty, sudden reversals. To actually see these trends objectively without getting faked out by daily noise, traders rely on moving averages. One of the most popular strategies here is the moving average crossover. Basically, we're comparing a short-term moving average with a long-term one. When the 50-day moving average crosses above the 200-day moving average, that's called a golden cross. It's a huge, bullish signal telling us a major upward trend might be starting. Conversely, when that 50-day average drops below the 200-day, well, that's the infamous death cross, a very bearish signal. Using this mathematical crossover is brilliant because it completely removes your emotional guesswork. It just gives you a clear, objective heads up that a trend is shifting. Next up, we have support and resistance zones. And this brilliantly illustrates the tug-of-war in the market. Think of support as a tactical floor where buying pressure consistently steps in and stops prices from falling any further. Imagine a stock repeatedly dropping to exactly 100 rupees and then bouncing right back up. That 100 rupee mark, that's your support zone. Resistance is the exact opposite. It's a ceiling where selling pressure gets so intense it stops the price from going any higher. Identifying these levels is absolutely crucial because it helps you pinpoint those high-probability, low-risk entry and exit points. Simply put, you buy near the floor and you sell near the ceiling.
Section 2. The Triggers. Timing your trades.
First up in our trigger toolkit is the breakout trading strategy. Remember that ceiling of resistance we just talked about? Well, a breakout happens when the price violently smashes right through that ceiling or crashes completely through the support floor. Say a stock has been stubbornly stuck between 500 and 550 rupees for weeks, and then out of nowhere, it surges past 550. That's your breakout. But here's the catch. You have to look at the volume. You need to see a massive amount of shares changing hands to prove it's a real move. Otherwise, it might be a fake out. When the volume confirms it, this trigger lets you catch huge market moves right at their very beginning.
Now, if the thought of staring at charts all day waiting for a breakout sounds totally exhausting, swing trading is probably your perfect match. Unlike day trading where you're closing everything out before dinner, swing trading means you're holding positions for a few days to maybe a few weeks. You're capturing short to medium-term moves. If you've got a demanding full-time job or you're a full-time student, this is literally perfectly tailored for you. It gives you the breathing room to analyze the market in the evening, look for clear uptrends or pullbacks, and plan your moves without needing to obsess over the stock ticker every single second of the day.
Another incredible trigger tool is the RSI, or the Relative Strength Index. Think of the RSI like a speedometer. It's a momentum indicator that measures the speed and strength of price movements on a scale from 0 to 100. The absolute magic numbers you want to watch here are 70 and 30. If the RSI pushes above 70, the asset is considered overbought. Basically, it's heated up way too fast and is very likely to pull back. On the flip side, if it drops below 30, it's oversold and could be gearing up for a nice rebound. It gives you really simple, clear signals. But a quick heads up, RSI works best when you combine it with other tools, like those support and resistance levels.
Now, what's really interesting about this next strategy is the psychology behind it. Momentum trading is entirely about joining the party while it's in full swing. You're actively hunting for assets that are already moving aggressively in one direction, heavily backed by massive trading volume and usually kicked off by a catalyst like positive news. Imagine a company announces record-breaking earnings and boom, the stock jumps 10% in a single day. A momentum trader jumps right in, expecting that sheer brute force to carry the stock even higher over the next few days. The tricky part? Momentum can vanish as fast as it appears, so you absolutely have to stay vigilant and keep your stop-loss orders incredibly tight.
Let's compare that to a much safer, calmer approach, the pullback trading strategy. This perfectly highlights the difference between amateurs and pros. An amateur sees a stock skyrocketing and they just chase it, completely driven by FOMO, and end up buying right at the absolute peak. Professionals, though, they use patience. Say a stock rises beautifully from 100 to 130 rupees. Instead of jumping in at 130, the pro waits. Markets never move in a straight line forever. Eventually, the price takes a breath and falls back or pulls back, let's say to 120. That is your trigger. You buy at 120, bagging a much better price, fully expecting the broader uptrend to continue. You drastically reduce your risk just by waiting for that temporary dip.
To really fine-tune exactly when you enter those trades, we use candlestick patterns. These visual shapes on your chart are practically real-time psychological readouts of market sentiment. Look at the bullish patterns, like the hammer or the morning star. These are screaming that buyers are taking control and the price is likely to reverse upward. On the flip side, bearish patterns like the shooting star are a massive red flag warning you that sellers are overpowering the buyers. By memorizing just a few of these key visual cues and pairing them with your support and resistance lines, you're going to drastically improve your market timing and set yourself up for some seriously high probability wins.
Section 3. The Shield. Risk Management.
Okay, listen up, because risk management isn't just an afterthought, it is the ultimate strategy. It is the invisible shield that definitively separates the wealthy, long-term professionals from the broke amateurs. And it honestly all comes down to this one crucial number, 1 to 2%. So the crucial point is, write this down, memorize it, internalize it. This is the absolute golden rule of trading. You should literally never risk more than 1 to 2% of your total trading capital on any single trade, period. It doesn't matter how sure you are or how flawless the setup looks.
Let's ground that abstract percentage into a concrete reality so it really sticks. Say you've worked hard and saved up 50,000 rupees in trading capital. Your absolute maximum risk on a single trade should only be between 500 and 1,000 rupees. That means if the trade goes completely south and you hit your stop loss, you only lose 500 rupees. The brilliant part? Your account easily survives. You still have 49,500 rupees sitting there ready to trade the next day. If you risk half your account on a single bad trade, you're entirely wiped out. Capital protection has to be your #1 priority. Making profits is always #2.
To keep that shield completely intact, you've got to live by these essential risk rules. First up, always, without a single exception, use a stop-loss order to automatically cut a losing trade. Second, maintain a risk-reward ratio of at least 1 to 2. So if you're risking that 500 rupees, your target profit needs to be at least 1,000 rupees. Do that, and you can literally be wrong half the time and still make money. Third, avoid emotional decisions. If you're feeling panicked or overly euphoric, step away from the keyboard. And finally, do not overtrade. More trades do not equal more money. They just mean more risk. Even the greatest analytical system in the world will crash and burn if you ignore these defensive rules.
Section 4. Path to Trading Success.
So, if you're ready to build some genuine, long-term confidence in these markets, your next steps are super practical. Start out with the simple methods we've covered, like trend following and swing trading, combined with straightforward RSI and support levels. Seriously, don't overcomplicate it. Remember your shield. Preserve your capital first and foremost. Practice these setups regularly to build up that muscle memory. And this is vital. Keep a trading journal. I promise, it's not just busy work. It is your ultimate feedback loop. You just can't improve what you aren't measuring. Trading isn't a get-rich-quick scheme. It's a careful, disciplined process.
We've covered the foundations, the triggers, and the vital shield of risk management. So I want to leave you with this final, provocative thought. Are you ready to stop gambling? leave that casino mentality behind, and finally start trading with an actual strategy? The choice is entirely yours. Thanks for joining me on this explainer, and I'll catch you in the next one.